The system looks strong. Markets are calm. Banks feel solid. Headlines talk about resilience. Feels like we learned the lessons. But here's the uncomfortable truth. Modern financial systems don't eliminate fragility. They hide it. And the better they get at hiding it, the more dangerous it becomes. Because fragility doesn't announce itself. It waits. It accumulates. Then it shows up all at once. This story isn't about panic. It's about comfort. And why comfort is often the warning sign we miss. Right now matters because we're living inside one of the most stable-looking financial periods in history. At least on the surface. Crises feel shorter. Markets recover faster. Institutions talk confidently about risk management, stress tests, and safeguards. The language is reassuring. The graphs are smooth. That smoothness is the point. After the chaos of the early 20th century and the shock of 2008, the global system made a quiet decision. Volatility would no longer be tolerated. Sharp collapses were politically unacceptable. Disorder was seen as failure. So the mission changed. Not to make the system stronger, but to make it feel safer. To understand how fragility gets hidden, we need to rewind. Old financial systems failed often. Banks collapsed. Businesses went under. Recessions were frequent. It was messy, painful, and visible. But those failures acted like pressure valves. Weak parts broke early. Bad decisions were punished quickly. Risk didn't have time to pile up. Modern systems do the opposite. They smooth outcomes. They delay consequences. They absorb shocks. Central banks intervene earlier. Governments step in faster. Liquidity appears on demand. Failures are softened, merged, rescued, or quietly ignored. The system stops breaking in small ways. And that's where fragility starts. Because fragility isn't about how often something fails. It's about how badly it fails when it finally does. Imagine stacking weight onto a table. Slowly, carefully. Each time the table holds. So you add more, and more, and more. The table doesn't complain. No cracks, no sounds. Until suddenly it collapses. Not gradually, instantly. That's hidden fragility. In finance, the weight is debt. Debt feels harmless during stable periods. Low interest rates make borrowing feel responsible. Rational, even. Companies borrow to survive. Governments borrow to stabilize. Households borrow to maintain living standards. No single decision looks reckless. That's the trick. Debt grows quietly. Risk doesn't. Risk hides inside expectations. Expectations that growth will continue. That rates will stay manageable. That support will always arrive on time. And because these expectations hold for long periods, they start to feel permanent. This is where the system rewires behavior. When failure is rare, people stop planning for it. When volatility is suppressed, risk looks smaller than it is. When rescues are expected, discipline fades. Not dramatically, subtly. A little more leverage. A little less margin for error. A little more dependence on stability. Over time, the system becomes optimized for calm conditions only. That's not resilience. That's dependency. Let's talk about the tools that hide fragility. First, interest rates. Low rates are powerful. They make borrowing cheap, refinancing easy, and cash less attractive. They encourage spending today instead of saving for tomorrow. In moderation, this supports growth. But when low rates persist for years, they distort decision-making. Projects that shouldn't exist survive. Companies that should fail linger. Investments are judged less on quality and more on access to cheap money. The system starts rewarding survival over strength. Second, liquidity. Modern markets are flooded with it. Liquidity feels like safety. You can sell assets quickly. You can exit positions. You can respond to shocks. Until everyone tries to do it at once. Liquidity is abundant in calm periods and vanishes in stress. That's not a flaw. That's how liquidity works. But systems built assuming constant liquidity are fragile by design. Third, risk models. They look scientific, precise, reassuring. But most are built using past data from calm periods. They assume tomorrow behaves like yesterday. They underestimate rare events by definition. The more stable the past looks, the more confident the models become, which is exactly when they're most wrong. Now let's talk about the irony. The more advanced a financial system becomes, the harder it is to see its weaknesses. Complexity hides fragility beautifully. Risks are sliced, packaged, diversified, and distributed. No single institution feels exposed. No single balance sheet looks dangerous. But the system as a whole becomes tightly coupled. When one part stumbles, others follow. Not because they're reckless, but because they're connected. This is why modern crises spread so fast. They don't move through obvious channels. They jump through confidence, liquidity, and expectations. That's why they feel sudden. Now contrast the hype with reality. The hype says, we have safeguards, we have tools, we can manage downturns. The reality is quieter. Those tools work best when used rarely. Each use reduces their future effectiveness. Each intervention teaches the system to rely on them. Over time, the system learns the wrong lesson. Not be careful, but someone will catch us. This creates moral hazard, but not in the cartoonish sense. Not greedy villains, just rational actors responding to incentives. That's what makes it dangerous. Now zoom out. Hidden fragility doesn't just affect markets. It reshapes society. Asset prices rise faster than productivity. Those who own assets benefit from stability. Those who don't experience stagnation. Inequality widens quietly, not through collapse, through calm. People are told the economy is strong, but their experience says otherwise. Trust erodes, not explosively but steadily. At the same time, governments become constrained. High debt limits policy choices. Small shocks require large responses. Flexibility disappears. The system becomes stable on the surface but brittle underneath. This is why shocks feel bigger now. A rate hike ripples through housing, markets, currencies, and politics. A supply disruption triggers inflation. A small default creates outsized fear. Fragility amplifies everything. And here's the final uncomfortable mechanism. Stability creates complacency. Complacency creates exposure. Exposure creates fragility. The longer stability lasts, the more the system depends on it. Eventually, reality interrupts. Not because someone made a mistake, but because assumptions finally meet limits. When that happens, the question isn't whether the system survives. It usually does. The real question is who absorbs the shock. Because hidden fragility always reveals itself unevenly. Some lose jobs, some lose savings, some lose trust, and only afterward do we see the cracks that were always there. So the next time everything feels calm, smooth, and under control, it's worth asking a harder question. Is the system actually strong, or is it just very good at hiding where it would break?